What if I told you that you could have a retirement income of $100,000 per year and pay nothing, I mean zero, in federal income taxes? Now, I know that sounds like clickbait, but it's not. This isn't about shady loopholes or complicated tax hacks. It's simply about understanding how the tax code actually works and then using those rules to your advantage. But before we get started, I'm Phil, I'm a certified financial planner, and today I'm going to show you exactly how this can happen in real life. By the end, you'll see how a couple can live on $100,000 per year, pay nothing in federal tax, and even set themselves up to pay less tax in the future. And as you'll see, this isn't cookie cutter. What works beautifully for one couple could be disastrous for another. So let's meet our case study couple. We'll call them Lois and Clark. They're both 67 years old, recently retired, and excited to enjoy this next phase of life. Their goal is simple: spend $100,000 per year in retirement and not feel like they're pinching pennies. Here's their financial picture. They've got about $500,000 in a traditional IRA. They've got $300,000 in a Roth IRA and about $250,000 in a regular taxable brokerage account. Between the two of them, Social Security will pay $60,000 per year. No mortgage, no debt. Honestly, they've done a lot of things right. So the question, can they really take $100,000 and pay nothing in federal taxes? Let's start with the foundation, deductions in brackets. In 2025, the standard deduction for a married couple, both age 65 or older, is $46,700. Now let's pause there for a second because that number looks big, and it is. Here's why it's $46,700. The base standard deduction for married filing jointly is $31,500 for 2025 due to the One Big Beautiful Bill Act. But also due to that new act, each spouse gets an additional extra $6,000 added on top for being over 65. That's $12,000 more. And then there's another small age-related adjustment of $3,200 combined, or $1,600 separate. Add it all up and you get $46,700. So before Lois and Clark owe a dime in federal tax, they get to knock off nearly $47,000 off of their income. That's one of the reasons retirement tax planning is a completely different game than tax planning while you're working. And here's another key piece, the 0% long-term capital gains bracket. For 2025, that extends all the way up to $96,700 of taxable income. So think of it this way. The IRS has three buckets for your gains: the 0% bucket, the 15% bucket, and the 20% bucket. If you can keep your taxable income under $96,700, you're in the 0% bucket. You could sell stock, realize gains, and owe nothing in federal tax. There's a great strategy tied to that called tax gain harvesting that I'll talk about in another video. And the last piece we need to layer in here is Social Security. And this one trips up a lot of people because Social Security isn't fully taxable. How much gets taxed depends on something called provisional income. Now, here's the quick version. The IRS looks at half of your Social Security and then adds in other income like IRA withdrawals, capital gains, or tax-exempt interest. The total provisional income determines how much of your benefits are included as taxable income. Now, if you'd like me to dive deeper into provisional income in a future video, drop a quick comment below, let me know. So let's see how this all plays out for Lois and Clark. Together, they're bringing in $60,000 of Social Security. The IRS looks at half of that, $30,000, and then adds in their other income. So to reach their $100,000 goal, here's the initial game plan. They're going to pull $30,000 from their brokerage account. Now, here's the part most people forget. Only the gains are taxable. The money they originally invested, what we call basis, comes back tax-free. So of that $30,000 in this example, about $20,000 is basis and only $10,000 is actual gain. So now the math looks like this. $30,000 from half their Social Security plus $10,000 from their gains equals $40,000 of provisional income. And at that level, only about $4,000 of their Social Security benefit ends up as taxable income, not the whole thing, just that small slice because of how the IRS phases it in. So when you add it all together, Lois and Clark have $14,000 of taxable income. Now here's where that $46,700 standard deduction changes everything. $14,000 minus $46,700 leaves them with negative taxable income. Yes, negative taxable income. Now, not something that we can carry forward, but something we can strategize with this year. That's like playing golf and being 28 strokes under par. It means they have plenty of room to spare. At this point, they've got $60,000 from Social Security and $30,000 from the brokerage. That's $90,000. They still need $10,000 to reach their $100,000 target. Now, some people might assume they should just pull that $10,000 from the Roth because Roth withdrawals don't show up as taxable income. But here's the thing. In this case, that would actually be the wrong move. Since their taxable income is already negative after deductions, they can take the money from their traditional IRA, reduce their future required minimum distributions, and still pay zero tax today. That's a double win in my book. And here's where it gets even better. Remember that they had $32,700 of unused deduction space left. They could actually take that much more from their IRA or even convert it to their Roth IRA and still pay nothing in federal income tax. That's powerful because it means that they can chip away at their future RMDs and give more money the chance to grow tax-free. And this is exactly why retirement income planning isn't just about pulling money when you need it. It's about sequencing withdrawals, coordinating Social Security, and paying attention to the brackets. And I'll tell you, when people see how much tax they don't have to pay, their shoulders drop about 3 inches. And hey, if you're watching this and thinking, wow, I wish someone would run these numbers for me, that's exactly what I do every day with clients. If you're curious how close you are to your own version of a zero tax retirement, I'll drop a link below where you can connect with me. No pressure, just a conversation about your plan. Now here's the part I don't want you to miss. This works beautifully for Lois and Clark, but it doesn't mean it will work the same for you. If their brokerage account had a much lower basis, say all $30,000 was gained instead of $10,000, their Social Security would have been much more taxable. If all of their money was in IRAs and they didn't have the brokerage at all, the tax math would look completely different. That's why I always say what's perfect for one retiree could be disastrous for another. And remember, this isn't forever. Right now, Lois and Clark can enjoy $100,000 tax-free, but at age 75, required minimum distributions will kick in and their income picture will absolutely change. That's why the best use of this strategy is proactive. Use your deduction space each year. Harvest gains or do Roth conversions intentionally, and always keep an eye on Medicare's IRMAA thresholds, which for 2025 start at $212,000 for married couples. Lois and Clark are nowhere near that today, but later on, larger conversions could make a difference. And here's the big picture. The tax code isn't just about what you owe this year. It's about how you manage income over decades. By blending Social Security, taxable accounts, and IRAs in a thoughtful way, by using the standard deduction to their advantage, and by taking full advantage of the 0% capital gains bracket, Lois and Clark can enjoy a 6-figure lifestyle when paying nothing in federal taxes. So let me leave you with this. How close are you to your own version of a zero tax retirement? The only way to know is to run the numbers, because education is how we start, planning is how we build, and execution is how we obtain freedom. And when you will learn how to navigate the tax code this way, you're not just avoiding taxes, you're learning to navigate your wealth and elevate your life.